welcome. It is time to get started, and we appreciate you being with us today. We have traders attending from all around the world, so whatever time it may be for you, and I know some are here really early in the day and some really late in the day, and we really appreciate you doing that for us and hope you have a good day. I know these are tough times for a lot of people. We do trust that you and your family, friends, loved ones are staying safe and staying well. This is Craig at Max Trading. Chris and Eusebio are here, and we are very glad to include you in the Max community today. Other traders will be joining us later by means of our playback video, and we welcome you as well. It's true that the COVID virus has made things difficult for most of us, maybe all of us, but I do love it that trading can be done very safely within your own home. So this may be the perfect time for you to learn a very profitable system, and we enjoy having the opportunity to show it to you today. Really, it's an exciting time for us because we are so very well acquainted with the Max trading system. We've been trading it, after all, for about 12 years now, so we know that it is a tried and proven system. In fact, more than 2,000 traders have graduated from a Max course, and you know what? That's a lot of training, and we've learned how to do it with maximum effectiveness. You will get the help that you need and more. In fact, on the 5th of November, we begin our 71st standard course where you can learn a very profitable, very flexible system. And by the way, it is excellent for all markets and all time frames. If you like the excitement of fast charts, say 1 minute or 5 minute, you will love Max trading. Or maybe you're one who performs a little better on slower charts, 15 minutes, 30 minutes, 1 hour. Max is for you as well. And then there are always those who want lots of time away from the computer, and so you like 4-hour or 8-hour or daily charts, and Max is for you as well. I recently helped one of our members set up 12-hour charts, and he was so excited about trading that longer time frame. And if your preferred market is the YM, ES, or DAX, Forex pairs, commodities, or maybe options or stocks, Max is also for you. Very flexible, very powerful, and you will enjoy trading at whatever your preferred market. And with Max, you also get a great trading community. Many of you will be taking a Max course with us starting next week, and this also gives you a lifetime Max membership. So we look forward to trading with you for many years yet to come. The Max community is not only fun and lots of great camaraderie, and that's important, but it is also a place where you get a wealth of ongoing support and never-ending assistance, and also free trading workshops, at least 2 or 3 every month of the year. And this allows you to continue growing as a trader, continue improving your skills. New ideas can be really important. They help us meet the challenges of trading, and you're probably aware that the markets, the characteristics of the markets change from time to time, and this can make it difficult. But when you have an influx of new ideas, and by the way, Max trading at its core is exactly the same as it was when Dr. Pruitt first shared it with us 12 years ago. But along the way, there have been a number of refinements and improvements, and Eusebio has helped us recently to meet the challenge of changing markets by developing a solution which we call the Max Enhanced Trade Format Indicator, which is way too much to be saying, so we just call it the ETF. It has proven itself as a very effective addition to Max trading, and I'm very confident you will love it. And you get that indicator along with the companion at no additional expense. It's included with your Max course. The companion is our price directional bias indicator. It makes a huge difference in trading results, and all of these things put together, the professional training, the correct price action analysis, knowledgeable global context, very effective indicators, a supportive trading community, and lifetime assistance through the MAX community. These things combine to give you a real shot at the kind of trading that will make a difference in your life. And by the way, we do not expect you to simply take our word for it. We want you to see for yourself. I will be sending you the video from our live trading session just this past Wednesday. You'll get to see on real-time charts the effectiveness of the MAX trading system. And the great thing about live charts, and I just love this, you cannot exaggerate, you cannot hide. Everything is right there out in the open for everyone to see. I hope you will enjoy the video. Thank you again for attending today. And if you have questions, please ask. You can do that anytime using the question panel in GoToWebinar. And you may need to take a look at view and deactivate the auto hide if you're not able to see the question or chat panels. But we want every question to get answered. The door prize drawing is coming up during our Q&A time. Stay with us. It's your chance to win. Eusebio is the developer of ETF and the companion. He has traded the MAX system full-time for many years, and I think he's the perfect choice to give us all the details about MAX trading. Not only is he a phenomenal trader, he is also a very skilled coach. And I really enjoy the genuine pleasure that I see in him as he helps his fellow traders. I like that a lot. So Eusebio, thank you. We are grateful for all that you do. And thank you as well for taking time with us to show us MAX trading today. The microphone is yours.
Thank you very much, Craig, and it's always a pleasure for me to show the MAX, in fact. So welcome to everyone. I'm really glad to see you during this presentation, and also all the participants who will watch the recorded video, because this session will be, of course, recorded and the video will be made available. So before starting, I always like to make a quick check, video and audio check. Do you see my screen and do you hear me well? So if you would like to type a yes or Y in the question area or in the private MAX chat room for the MAX members who have logged into the chat room, so I would really appreciate. So thanks, Corny, Anton, Stefan, Konstantinos, Gary, Robert, Vipul, William, and so on and so on. I really appreciate that kind of interaction. So many of you know who I am, but just in a few words, I will, for those who don't know me, I will just describe who I am. So I am a MAX instructor since 2009, mid-2009, after Dr. Jim Pruitt passed away. His two assistants and partners, Craig and Chris, have asked me if I would agree to teach the MAX, and so it has been a pleasure for me to accept, and so I enjoy since that moment to teach the MAX and to participate in the improvement of the MAX over time. And I am indeed a full-time trader in Forex since 2008, in fact. And I was a part-time trader since 2000 in the Forex, but I am interested in investing and in trading for many, many years, so for around now 35 years. Before I started to work as a software engineer, I have practiced that profession as a software engineer for about 30 years, and the last 15 years of my career, I have had the opportunity to work with important banks in Europe, in France, Germany, Switzerland, Belgium, Luxembourg, UK also. And this has given me the opportunity to be in contact with some traders, with some bank traders, and so to see and to try to understand how they consider their the position they take in the market. But as Craig has mentioned a few moments ago, so the max can be applied to any market, the forex market, of course, the currency market, of course, the futures market, the stock market, and if you can trade the stock market, you can trade also the corresponding option market. Any time frame, so from the smallest one to the largest one, so the methodology is exactly the same. There are some nuances depending on the time frames, but the methodology is very similar. So this presentation is absolutely adequate depending on who you are yourself. You may be an experienced trader looking for more consistency in your trading process, and so if you are in this category, then the max is certainly for you. If you are a full-time trader and you want to multiply your profit, you want to generate more profits or additional profits, then the max is also certainly for you, because the max will give you lots of opportunities to trade. If you are a trader still struggling to become consistently profitable, then certainly the max is also for you, because with the max you will learn a methodology containing several important aspects I will explain later, which will help you to become consistently profitable over time. If you are a new trader and you need to get some education in trading and you need a reliable trading approach, then the max is also for you. So you can start from scratch, having no experience, having no knowledge in trading. So the max provides you with all the information you need to, and all the education you need to begin to trade consistently. If you want to work from home, if you want to plan for retirement, then trading with the max is certainly for you too. This is the advantage of trading. You can trade from everywhere. You just need, in fact, a PC and an internet connection, and so you can begin to trade if you have time enough to dedicate to trading. And so trading from home, so working from home is an adequate approach with the max. The max is a very, very powerful trading system developed many years ago by late Dr. Jim Pruitt, or James Pruitt. In fact, we were all calling him Jim or Tiger. Tiger was his nickname due to a very strong temperament, and I remember being rolled by the tiger was a very tremendous, amazing, sometimes traumatic experience. So, but the aim of Jim was to share his experience as fast as possible, because he knew at that moment that his time was counted, unfortunately. But the MAXO is an acronym which stands for several important concepts. The M of the MAX stands for momentum. Indeed, we want to consider a possible trade only when the price exhibits some momentum and some volatility. And so we need to have ways to appreciate or to measure that momentum and that volatility. The A of the MAX stands for acceleration. When we say acceleration, we don't necessarily mean that the price needs to accelerate. Here, acceleration means accelerating the profits we can extract from a movement, we can extract from a trend we are exploiting. And we accelerate that, profit accumulation by scaling in order to progressively build a larger position we can handle along the trade. But of course, doing that, we have to control the risk introduced by all these scalings. And this is something which is essential in the MAX, and I will show you the effect of scaling in when we do that properly in the result we can extract from any trend. And the X of the MAX stands for exit. At some point, once we have opened a trade, this means that we want to close the trade later, possibly with a profit and sometimes with a loss. And we will see that with the MAX we have mainly two types of exit, a partial exit and a total final exit. And so basically the MAX is a trend-following system, a trend-following method. I like to say method because it's not an approach based on simplistic rules which never change over time. These rules need to have some flexibility depending on the market conditions. The MAX also contains ways to trade counter-trend movement and to consider breakout situations. So breakout of important levels is also an important ingredient of the MAX, and it's still a very important ingredient of the MAX ETF nowadays. Of course, having a trading system based on some technical analysis, for example, it's not enough. It is also absolutely necessary to complement that approach with a very strict trade risk management, but also money management, and also to have an excellent idea or an excellent understanding of the global context. And so the MAX is in fact a system based on three pillars: technical analysis, global context analysis, and trade risk management and money management. And as I have said earlier, it is applicable to any time frame and to any market. So before to show you some details about the concept and the rules of the MAX, I would like first of all to show you in fact three types of tips, or three trading tips you can apply also immediately into your own trading process, and these three tips will improve your trading and your result. And of course, these tips are completely part of the MAX trading system. They are three of many of the tips, many of the rules we are using in the MAX. And after that, I will illustrate some of the concepts through some examples of recent trades made with the MAX. So the first tip I would like to show you is how we can use, in fact, some types of divergence in order to reduce the risk when we open a trade and when we have to handle the trade. I will show you also how the long bar can be used, in fact, to bank some interesting profits. And so the conclusion of banking some profit at some point along the trade is also a very important aspect of reducing the risk when we are in an open trade. In fact, what we have learned through years of trading is the following point. The first priority of a trader is never to try or to hunt for profits. Of course, the ending aim is to generate profits, but the first priority of a trader is to take risk in the market, to assume risk and to take these risks. And then the second priority, because there is always a risk when we take a trade, it's to handle that risk in order to progressively reduce that risk until we can completely cancel the risk, having a risk-free or even a guaranteed profitable trade. And then when we are in a risk-free situation or in a guaranteed profitable trade, then we can focus on optimizing the profit we can extract from the trade in order to produce the profit we expect. And so I'm going to illustrate through some examples. So these three concepts we use extensively in the MAX. This is an example of a downtrend. And along this downtrend, don't focus necessarily now for the moment on the indicators we have on the chart. I will come back to that in a moment. But one of these indicators we are using is this oscillator in magenta color, which is called the stochastic of the RSI, in abbreviation the STO-RSI. And this stochastic of the RSI or STO-RSI exhibit a lot of different patterns. And these patterns can be used specifically to handle our partial exit. In this example of a trade, we have, for example, an entry, a short entry on this place on the chart. And then later we can see that the price is making two successive lows. In fact, many of you already know what a divergence is. But with these two lower lows in the price, the corresponding lows in the STO-RSI are in fact, in the opposite order. We have two higher lows in the STO-RSI. We call that a basic divergence. It is a momentum basic divergence, and there are lots of different types of divergences. In the MAX, we teach 4 types of different divergence situation. And when we have a divergence, in fact, we can consider to partially close the trade. In fact, as I will show later, whenever we have a trade, whenever we open the trade, we consider that the trade is made of 2 units. In the course, we indeed teach how to calculate the size of these two units. But when we have an exit setup, and so a divergence is an exit setup, we will close one unit. The way to close the unit is also explained in great detail in the course. So we do not necessarily close immediately one unit when a divergence appears. We want to have some confirmation. So we have an exit setup corresponding to the divergence. We then define an exit level, and if the price follows through and hit that exit level, so we close one unit, and we will call that unit an MX, or a partial exit named, so MX. MX stands for momentum exit, and so we close one unit, and this is the exit, the partial exit number one. Later on in the same movement, we have again at some point two lower lows in the price, two successive lower lows in the price, and again two higher lows in the Stowe-Erosai indicator. And so this blue candle is again an exit setup. We define an exit level, and if the price hit that level, so we make another partial exit. And of course, depending on the number of entries, the number of units, open units we have due to the scaling process I will illustrate later, we may have several exits. So along the trend, for example, here we have again two lower lows in the price, two higher highs, two higher lows in the Stowe-Erosai, and so we have again an exit. And in this case, because we have other indications telling us that this movement is possibly exhausting, we have to consider not a partial exit, but a full exit, whatever the number of open units we have at that moment. So, and so the Stowe-Erosai or any momentum oscillator can be used with its different patterns, and among these patterns, so the divergences may be used for exit technique. Now, there is a point which is extremely important to understand about the exit technique. We never use an indicator in order to predict what the price can do. It's not because the Stowe-Erosai and the price are diverging that we can predict that the price will make a pullback or will reverse. No, we use instead an exit technique as a way to measure if the risk, or to quantify the risk introduced in our position by the fact that the price is pulling back until that risk becomes too much important. And so it's a way to quantify the importance of the risk. And when this risk becomes too much important, we have to decide to make an exit in order to reduce that risk. Because this is the second concept we have in the max. Whenever we open a trade and we have an initial stop loss, so we have a risk, and the risk corresponds not only to the size of the stop loss, in this example 22 bits, but also to the size of the trade. And when we see the price moving in our favor, we have a potential profit the trade is producing. But whenever the price will make a pullback, this pullback will erase a portion, a part of the profit, the potential profit we are making. And if the pullback is a deep pullback, this deep pullback can even cancel totally the potential profit we are making. And so a pullback always corresponds to a risk for the trade we are handling. And the problem is, until when will we accept the price pulling back? And so this is typically a trade risk management. But when we close one unit by banking a profit, not only we have banked a profit on that portion of the trade, but this also participates to reduce the risk on the remaining open unit. Because let's say, for example, that on the first unit we have made a 13 pips profits. So we still have a 22 pips risk on the second unit, but globally, the remaining risk on the second unit is only 9 pips. And so the risk is no longer 22 pips, but only 9 pips. We have divided the risk by more than 2. And so we will have much more flexibility in order to close the second unit or any other open unit we may have if we make some scalings. I will come back to the scaling in a moment. So the divergence is an important aspect of the exit technique, so when we use such a momentum oscillator. This is an example in an uptrend, and so in an uptrend, whenever the price will make 2 successive higher highs, and at the same time the Stowe-Erosai will make 2 corresponding lower highs, we will have also a basic divergence, and if the price pulls back enough, so we can make a partial exit closing one unit. And you can see that in this example, when the first divergence applied, we are able to make a very nice profit compared to the size of our stop loss. And later, the next exit technique is given by this second divergence. Later, if we still have open units, so we have another full exit. So with the third divergence we have between the price and the store RSI. So the basic divergence of any momentum oscillator and the banking of profits are extremely important ways to control the risk we have on the trade. And this is one category of the exit technique. We have several types of exit technique based on indicators, but also based on pure price action. An example of exit technique based on pure price action is the long bar. Whenever we have a candle being a long bar in the direction of the trend, for example, here we are in an uptrend, and this blue bar is a long bar. A long bar is a bar having a length, and the length is defined from the high to the low of the candle, having a length which is at least twice or more, of course, so 2 times or more the average length of the candle preceding the long bar. In the course, we define precisely how to determine the candles preceding the long bar. And so we have to consider the average length of all these bars here. And if the length of the potential long bar is twice or more than the average length of this preceding bar, so we have what we call a long bar. And a long bar always represents a situation when the price has moved far away from our initial entry, and so gives a nice potential profits. In this case, when we observe the charts in the past for all the pairs, for all the time frames, and for many years, we observe that 2 out of 3 times a long bar is followed by a pullback, and sometimes even a deep pullback. And 1 out of 3 times, the long bar is not followed by a pullback, but by a continuation of the trend, or sometimes a small pullback and then the resumption of the trend. So 2 out of 3 times is important enough as a trade risk management to consider that when we see a long bar in favor of the trade, so moving in the direction of our trade, a long bar is always a nice opportunity to bank also some profit. And so when we see a long bar on the chart, we define an exit level corresponding to some pullback the price can possibly make, and it will make that pullback 2 out of 3 times. And there are several ways to define that exit level, and in the course we describe how to do that. It's enough to say that we can take a portion of the length of the bar as a potential retracement, and so this portion of the length of the bar defines our exit level. And if the price pulls back indeed and reaches this exit level, we make a partial exit. And so we have an example of a long bar here, making a nice 40 pips profit. And later on we have another long bar here, giving also a nice profit, etc., etc. And you can see that in this example, we can combine several exit techniques. In this example, we have 2 long bars, but later we have again divergences between the price and the store RSI. And whenever you can bank through whatever the exit technique you can use, you can exhibit some profit. These profit will participate, first of all, to reduce the risk on the trade, and then when you combine that also with your stop loss adjustment, this will contribute to achieve very quickly a risk-free situation or even a guaranteed profitable trade. And so banking a profit, making partial exit based on different types of exit techniques are very important ingredients, and I have shown 2 of them. So here the long bar and the divergence, important ingredient of the max. But we have also exit techniques based on oscillators, pure price action, combination of price action and another indicator, based also on the concept of movement invalidation, because of course at some point when the price retraces to some point, so the movement make no longer sense to be traded. And we have also the trend reversal exit technique and also time constraint consideration to define exit moment for our trades. And so if you apply these 2 exit techniques in your trading approach, you will generally improve your profit almost always and almost immediately. So, and this is why this is part of what we call the trade risk management. Instead of focusing on how we can generate the profit, we focus on how we can handle the risk we are facing while in a trade. And of course, now let me show you in a more general way what the max is through some example, some recent example. So on this chart, I'm going to show you the max ETF primer and the max ETF standard level of the max. The max ETF primer is just a small subset of the max to give the students of the max ETF primer a quick idea what the max is and to possibly consider later to study the max ETF standard level. On the chart, you can see several components. First of all, there is the price, of course, in the main chart. And you see two lines, one in yellow, one in orange. And these two lines are called the ETF lines, which is a very complex kind of, I would say, moving average. But it is not exactly a moving average. It's more complex than a moving average. And when the price is nicely trending, these two ETF lines are extremely regular and well separated, forming a small channel. We have also a short-term moving average, which is called the MO line, or the momentum line, which plays an important role to define the market conditions. And we have several types of market conditions we have to understand. We make the distinction between a trend mode, a counter-trend mode, a consolidation zone mode, a choppy mode, and a spaghetti zone. And then we have a long-term moving average, which is called the home base, so, which is the middle blue line of these three blue lines, and the upper and lower blue line make what we call the home base channel. It is approximately a 200 exponential moving average, and so it plays an important role to confirm at some point when a trend is unfolding, but also it plays an important role to define where the price can possibly begin to range at some point, because this long-term moving average is used by many traders, even the big boys, in fact. Another indication, very important indication you see on the chart, are all these horizontal lines. The colors of these lines are not important, it's just a way to remember which time frame have been used to define these levels, but they are all important and they are all similar. And these levels represent possible supply and demand level. You may call them support and resistance if you want, but they really correspond to supply and demand level, and they are defined and updated every weekend, so every Saturday. This is an example of a trade which has been made on the 29th of October, so it was Thursday, and so these levels have been defined on the 25th of October, so the previous Saturday. And you can see how the price nicely respect these levels. And then you recognize the store RSI and then our companion indicator, which is made of two lines. The green and red line is called the slow bias. The blue and orange line is called the fast bias. And on the technical point of view, the slow bias, so the red and green line, represent the technical trend. When the slow bias is red, we are supposed to take only short trades. And when the slow bias is green, we are supposed to take only long trades. Now we have to make the distinction also between the technical trend given by the companion indicator and the trend defined by the global context, and we call that the max bias advantage. And the max bias advantage or global context take into account a lot of geopolitical elements, the central bank decisions, the news release, of course, and some other consideration which may impact, which may have an influence so in the market. For example, when we trade with a small time frame, this is an example of a 5-minute time frame, we have what we call critical time period during the day, which are times during the day when we have to pay attention, sorry, because the price can possibly make some reaction. And so in this example, so we are in a downtrend. The bias was to short the euro-yen, and when on the technical point of view, the slow bias was showing also a downtrend, so we had the confluence between the technical trend and the global context buyers to consider a short trade. And this short trade has started, for example, in fact the short trade has started already earlier, but I have considered the trade starting here. We have a first entry. When we make the entry, so the trade is made of 2 units, and then when we have, you recognize here a long bar, so this was an exit setup, we make a first exit, so we close one of our 2 units. And later on, the next exit setup appears here, and here we have the confluence between, so this other long bar, and then an attempt to reject this max price levels. And so we have a nice opportunity to make another exit, and so we have closed here the first trade because the 2 units of the trade have been closed. And this trade has made a first profit of 14 pips and 33 pips for the 2 units, so a total profit of 47 pips, representing a reward to risk ratio of plus 1.57 R. So compared to the size of the stop loss. Later on, we can see that when the price succeeds to cross the max price level, the trend resumes to the downside. We had an opportunity to open a second trade, and we have exactly the same mechanism. In the first step, when we have this next max price level rejection, we make another partial exit, and then later on here, based on other exit techniques we have, so we can close a second unit, so closing the second trade, again for a nice profit of 57 pips or plus 1.14 R. And you can see that during the European session, there was a small trade here, but this small trade here would have been with a small profit, very small profit, so I have not considered that trade. So globally, 2 nice trade, 2 profitable trade, until we get here a news release. This news release was an important news release on the US dollar. It was I don't remember which, it was the advanced GDP quarter over quarter. And because an important news release, when there is an important surprise, positive or negative, can always create an important volatility in the market and possibly a volatility against our trade. So we have an important rule that 15 to 30 minutes before the news release, if we are engaged in a trade, we close the trade, or if we are not in a trade, but a new setup appears within the last 1 hour before the news release, we have to skip that trade. After the news, if there is some other opportunities in agreement with the news, so because the global context can be changed with the news release, so we can consider another trade. So, but that day during the European session with the Euro-Yen pair, so 2 trades, 2 nice profits trade. Now this same movement, which has produced 2 simple max ETF primer trade, can be handled in a completely different way with the max ETF standard when we include the scaling process. We have the same entry, of course, and then we have the first same exit based on the long bar, but when the price resumes the trend, we have an opportunity to make a scaling. SC is an abbreviation for scaling, and so this represents a second entry. We open 2 additional units having the same size as our 2 initial units. And so we are left now with 3 open units because we have opened 2 times 2 units, but we have made an MX. Later on, we have the same second exit as in the max primer, but we are left with 2 open units. The 2 partial exit have closed the 2 units of the entry number 1. So we are left with the 2 entry of the scaling. Later on, when the price crosses the max price level, we have an opportunity to make another scaling, which corresponds to our 3rd entry, leaving us now with 4 open units. And then later on, we have an exit setup triggering in this area, allowing us to close 1 unit. And so on and so on. We repeat the process. A few bars later, we have another opportunity to make a scaling. Then immediately after that, we have an exit setup allowing us to close 1 unit, and then a last scaling, and then several partial exit until the final exit click, which corresponds here to a trend reversal. And so we can see that we have had, in fact, 5 entries for 10 units, and we have made 6 partial exits. So we have closed 6 units. We are left with 4 units. When we make our final exit, our full exit, we close the 4 remaining open units. And now when we add up the profit of each of these 10 units, the profit totals to 229 pips, representing, because of a stop loss of 15 pips, so a reward to risk ratio of plus 7.63R. 7.63R to be compared with the 2.71R of the Max ETF primer. If you use a risk of 1% of your trading account, so this represents a 7.6% profit that day only with that unique trade in your trading account. If you use a 2% risk, this represents a little more than 15% on your trading account. I never advise to use a risk more than 2% because when you face some losing trade, and with the Max we face some losing trade, so the loss may be considered as an important loss. But when we apply the rules of the Max correctly, a loss is always a small loss. This is another example on the pound yen, similarly in a downtrend with the Max ETF primer. So we had 3 trades, or there was a small typo here. We had a first entry here with the 2 successive exit, then a second entry here with the 2 successive exit, and then a last entry here with a direct full exit because we were approaching a critical time period, forcing us to close the trade without making a partial exit. So we have also rules which tell us when a trend is susceptible, is possibly exhausting before the moment when it will usually exhaust. And so 3 trades, 3 profitable trades, again with a nice 3.39R for the reward to risk ratio. Now this same movement with the Max ETF standard allowing for scale-ins shows a different result, a way bigger result. So we have an initial entry, an MX, a second, another scale-in, an exit, a scale-in, an exit, a scale-in, an exit, another exit, another exit, another exit, a scale-in, and a full exit, the total exit. So in this case, we were left with only 3 open units when we achieved that place of an exit. So, and the total profit of this trade with several scale-in, several partial exit is now a nice 420 pips for an impressive 12.35R to be compared with the 3.39R result of the Max ETF primer trade. And remember, there were 3 trades. Of course, there is something I have not shown on this chart in terms of trade risk management. You have seen only for the trade risk management, so the partial exit. But another very important aspect of the trade risk management is the stop loss adjustment. Along the trade, of course, we also adjust based on specific rules. We adjust the stop loss whenever we can in order to participate in the risk reduction. Because, of course, whenever we make a scaling, each scaling introduces a risk in our new position. Not only it increases the size of the position, but it increases also the risk on the position. And to reduce, to control and to reduce that risk, we need to make these successive partial exits, but also to adjust our stop loss. An example of that stop loss adjustment is shown here in this pound card pair. So you have the same structure of the trade with the Max ETF primer, 1 entry, 2 successive exit, and the stop loss adjustment. Now the same movement with the Max ETF standard is a bit different. So you recognize the same structure, you recognize how we adjust the stop loss. We have specific rules for that, and you can see, you can observe the difference of the result between the 2 levels of the Max. The Max ETF primer without the scaling process, the Max ETF standard with the scaling process. So, and there is a result which is completely counterintuitive, but we show that we explain that in the course. When we catch a nice trend, upward or downward trend, and we have the opportunity to make several scalings, 2, 3, 4, 5 scalings. In fact, there is a point along the trend when whatever the number of scalings we make, there is no risk with these scalings. The risk is in fact completely cancelled, and in fact the only result we get is a larger and larger minimum profit we can obtain. So we are looking more and more profit with many more scaling we have the opportunity to do, provided we continue to apply the trade risk management rules correctly, meaning making a partial exit when necessary and correctly adjusting the stop loss along the trade. All the examples I have shown are based on the 5-minute time frame, but we can trade with any time frame, and we can trade any instrument. This is an example with a daily time frame with the S&P 500. So some MetaTrader broker allows to trade indices through CFDs, but you can also apply the max on any other platform like NinjaTrader, for example, in such a way that you can trade also in the futures market, and so you can trade the ES contract or any other index contract like the YM for the Dow Jones and so on, the NQ for the Nasdaq and so on. And you can recognize exactly the same structure of the trade. Here we have a short entry setup, and here we have a full exit on that nice divergence, but also on the trend reversal, forcing us to close the 2 units. And this gives an idea of the reward to risk ratio this trade has produced. And the same movement with the Max ETF standard, so has provided an earlier entry, 2 scale-ins, 1, 2, 3, 4 partial exit and a final exit on the trend reversal, giving a reward to risk ratio which is, as you can see, 6 to 7 times larger than the result of the Max ETF Premier. So a nice 10.67 R profit, so on this short trade. And so these are some of the concepts and rules we are using within the Max. And so through this example, and I have used this example to illustrate some of the concepts we are using, you can see that the Max provide with trading methods and concepts that work, and they work, and the reason they work is because they are linked to some of the way the big boys manipulate the market. And when I say manipulate the market, it's not a pejorative connotation. The big boys need to handle their position in a very specific way because they are trading big amount of money. They don't have the flexibility we have as retail traders to open and close the trade. So they have to spread their orders in a very specific way to get execution for their trade. And sometimes they are forced to push the market in a specific direction when their objective is indeed to trade in the opposite direction, because they need to induce as many traders as possible in the opposite direction of their objective. So, and in the course we explain these concepts and how they apply in the Max. With the Max, we teach the students to reinforce their trading skills and the money management aspect. In fact, as I have said, the first priority of a trader is always to assess and to accept risk in trading. And then the second priority will be how to handle these risks through the trade risk management and the money management, which requires, in fact, to develop some specific skills through the concept and the rules of the Max. I have said that the 3 pillars of the Max are the technical analysis aspect of the market, but also the trade risk and money management, but also the global context. In order to help our members to understand that global context, so we provide in our website on the page which is called the News Watch List or the News Watch page, and the link will be given in the chat area of GoToWebinar. We provide free information, so which are updated every Saturday or every Sunday, so every weekend. If you want to be informed of the update, you can subscribe to the information. The information is completely free, so you can specify your name, your email address, or you can simply consult the page every Sunday, for example. And we give, first of all, a list of all the geopoliticals we have to pay attention. It's clear that for the moment we still have an important context with the coronavirus, which has a deep impact in the economies of many, many countries. We still have to pay attention to the Brexit, and of course we have to always check what the Fed is doing every day in the market, because the Fed can make daily operations, and these daily operations, which are completely different from their decision in terms of interest rates, can have a deep impact in the market, especially in the US dollar. And so our news watch list describe some of the geopolitical elements we have to pay attention day after day after day. Then we also provide a simplified economical calendar. If you observe an economical calendar, and we like to use, for example, the calendar of Forex Factory because it is a clear calendar, you can see that day after day there are many days. There are many news. Some days there are more than 50, 70, 100 news for the day. But most of these news are not important at all, at least for the Forex. And so for each day of the week, we mention only the news which are really important. Those news who may have an impact in the market in the case of a surprise. And we label them in two ways, either a major or a monitor news. A major news is a news which can have a deep impact in the market if there is a big surprise on the related news release. And we make also the distinction between a news which may have an impact only in small time frames, but also in higher time frame. When we indicate major H4+, this is a news which, in case of a big surprise, can have an impact also on higher time frames. A news which is labeled simply major will have an impact only in the small time frames. And a monitor news is simply a news which, in case of a big surprise, can simply produce some volatility in the market, but not extreme movement, not big movement. And so major news is a news we have to pay attention, and we never trade against a news, but a monitor news is a news we can exploit in our trade. And you can see that day after day there will be less news. We consider only the news which are really important, making the calendar easier to understand. And then we also provide, because remember the MAX is a trend following method, and in order to be successful with the trend following method, we need to trade trending pairs. And not all the pairs are trending the same way. And so we provide every week a list we call the top 10 pair list, the list of the top 10, the 10 best moving pairs in the decreasing order. So the first pair of the list is the most trending pair, then the next one is the second trending pair, and so on. Of course, this list can change week after week. There may be some small changes. For example, one week we may have the pound US dollar being the most trending pair, and the following week it will be perhaps the pound yen. But globally we will have small changes week after week. And we give also the range not only in pips but also in dollars, the average daily range in dollars. Because in fact it is not the pips range which is important, but what is the money we can make. You can see, for example, that a pair like the pound US dollar has an average daily range in pips of 111 pips, but it produces more money than a pair like the pound kiwi, which has a range of 155, but which produces less money, or even the pound cad, which produces less money. And so we consider the best trading pairs as based on the average daily range in dollars. And then on the same page later, it is in our Newswatch list pair. So below the top 10 pair, we provide for each day of the week the pairs we recommend for each day. Okay, and this recommendation changes week after week. So these information are free of charge, and so everyone can access. You don't need to be a MAX member to access that information, but of course if you are a MAX member, you will have a better understanding how to exploit these informations. And then we provide also two services based on a small monthly fee. First of all, the MAX Bias Advantage, where for a certain number of pairs, some indices, some commodities, and some bonds, I provide every day in a manual way, depending on my analysis of the global context, so the directional bias for all these instruments. The importance of the bias is given by a number of euro. We have from 1 to 3 euro, depending if the bias is risky or if it is a strong bias. And the shape of the euro and the color of the euro indicate the direction of the bias. So up green euro represent a long bias, and a red down euro represent a short bias. So that day, which was the 24th of August, so we had these biases which can change over the day. So it may happen that for some pairs the bias can change one time or two times depending on what is happening and the influence this event, news or not, may have on the pairs. This is for short-term trading, in order to day trade with small time frame from the 1 minute up to the 1 hour, but I also provide the same bias for long-term traders using the 4-hour time frame or higher, and so I take the 28 pairs plus the same indices, commodities and bonds, and I provide the bias on a long-term perspective. So you have seen also on the chart I have shown, so the max price level. So these max price levels are also part of the monthly subscription. I provide for free the levels for 4 pairs, but for the other pairs, so there was a small monthly subscription. And so in fact, each courses of the max will provide you confidence in your skill, because there are a lot of activities after the course. We have in terms of mentoring, we have different free workshop along the year, but every Saturday we have free practice we call scrolling parties. We have also for each session in our course, we assign a homework to the students, and the homework is also a nice way. Chris will talk a little more about the homework, provide an important aspect in developing the skills of each student and developing also the confidence in the market, in the max, and in themselves. And so the 2 courses we want to propose you today, which are available today, are the Max ETF Standard Course, which is our flagship training containing the entire process with the scaling and the scale-out process. The scale-out process being the different exit technique with the MX notation, and the Max ETF Primer, which is, as I have said, just a small subset of the Max ETF Standard, just to give you an idea who we are and what the Max may be. So. And now, so that I have finished here my presentation, I give the mic to my friend Chris, who has very important complementary information to give you. So, Chris, the mic is yours if you want.
Thanks. As Eusebio said, I'm a partner in the Max Trading System. I was around when Craig and Eusebio kind of first met up with Jim back in 2008. This is our 71st set of Max courses. So each time we run about 2 or 3 different courses, and this is the 71st lot of them. And we've trained about over 2,000 traders since 2008. Just to give you an idea on our background, there's been a couple of questions come through as well. I just want to get them out of the road for Richard. Richard asked about the news there, Eusebio. Do we have an indicator that draws the news on the charts? I replied back to him that we don't recommend it, that not all the news that's in Forex Factory or in news indicators are applicable to when you're trading a particular pair or instrument. So, and it can be really distracting when you're doing that. So if you use the News Watch page, and each day you just mark on a chart, you don't have to have them all marked, but a particular chart, the time that the news comes out, just a vertical line, as it walks through towards you, it will remind you that there's news coming out at this point, and to be careful around that period. Sometimes when the news comes out, it can be quite shocking to the market and cause a lot of volatility. And so the whole idea of our trading, as Eusebio was saying, is to be very risk averse. So if there's news coming out, we aren't news traders, we try to avoid it. And so we don't place any orders just before it, and we get out of trades before it as well. And this is to lessen any impact that a surprise in the news might have on our account money, not just the profits that you might have made at that point, which would be great, but you don't want to lose your profits and your trading money at the same time, your account money. So we recommend that you keep out of the news, and we draw lines there. And the other question that Richard asked is, how do we locate trades on a daily basis? The setups that Eusebio was showing there on the charts can be applied to any time frame. So mostly we train on the M5, the smaller time frames, 5-minute time frames, but they're easily scaled up to any other time frame as well. All the criteria still apply, so it really doesn't matter which time frame you learn. We use the 5-minute time frame because there's just plenty of opportunities over a short period. And actually, if you've got the time to and the ability to trade those smaller, faster time frames, the smaller you go, the more profit there is, but they are harder to trade. There's more volatility because the news comes out and makes markets bounce around a lot more, whereas on the higher time frames, things are a lot more stable. So if you look at some of our results, we say that we get, say, 65 to 85% win rate, but when you go up to something like the H4 of the daily charts, it comes up to 90% plus win rates on those ones. Okay, and right, so let's move on. So the whole idea for doing the trading here is, and with the max, so that you get some sort of financial security and stability. As Craig was saying, these days with COVID around and jobs disappearing around the place because people cannot work, having another income, a side job or whatever it is called in your country, is really essential. And especially in some countries where you don't get hospital, there's not socialized medicine or anything like that, and a period in the hospital can be really crippling, like millions of dollars in some cases I've been reading. So if you have the ability to carry on trading and produce some money coming in, then it can be really, really helpful. It just takes the edge off, gives you a bit of a parachute, makes things a lot more stable. And if you're into retirement, then this is a really fun way of keeping up a retirement income. So the idea for this is to figure out how you're going to get there. A lot of people get PDFs and watch some videos and have a go at it. It can be kind of misleading, the trading side of things. People start out and there's a 50-50 chance that the first trade that they make will make money. Unlike other professions where if you want to become a brain surgeon, you don't just sort of crack open someone's skull and dig in there and you have a 50-50 chance of whether they make it out of there or not. You have to do a lot of training so that you can become really good at your actual profession. It doesn't matter what it is, but most professions are like this. Trading is a little different in that people can place a bet and they might win or they might lose. It's 50-50 at that point. But if you want to become consistently profitable, consistent making money, have something to rely on, then you need the supervision and the interaction, and you need consistent results, as we've been saying, and feedback and help from other organizations. So it's not a... I should also say that one of the really important things with us, with our training, and I haven't really seen it with any other training system, is that we ask you to do homework. So I'll hit up about that. But it's really important. A lot of people think that they know how to do the trading, early morning here in New Zealand, just after reading a PDF or something, and everything's okay, I can do this. But when you actually sit down and get your hands dirty writing up a chart, and then have somebody else have a look at it, that's when all the nuts and bolts start flying off your trading machine, and that's where we get to help you put them back on so that your machine works properly for you. So, and when you're training as well, or trading, there's a lot of challenges that you have to go through. You have to recognize what price action you're in, like consolidation chops, if there's how to trade around spikes, what direction you're supposed to go in. And Eusebio has helped hugely with that, with his bias, the ETF lines, and now his outside overall bias on the market. Okay, so as I just went through all that, using the max, you overcome and adapt to all of that. We show you how to find the trends and the counter trends and what to do in the breakouts and during chop. Because of the way Eusebio is created the ETF, we can trade a lot more often than we were back when Jim first developed this. And these days, the market movements are a lot tighter. You have to be much more precise, much faster, more nimble, and you have to adapt constantly to what the market is doing. Okay, this is what I was trying to get at. We have the details on the setups are very precise. So if you're trading the 5-minute time frames and say going through the Asian session, sometimes you can be as small as a half a pip from when the setup occurs to when you're actually entering. It can be that tight. Generally, it's around about, say, 1 to 3 pips for most of the other charts on the other times. And I think Brian's quote there, the other thing I hate is homework, is a really nice quote. Because, like I keep saying, you get a full system, precise, detailed setups, one-on-one guidance, and it can be bar by bar. In the practice sessions, if you find that you've got a tricky chart, we'll call it up and we will unmute you if you want, and so that you can describe your thinking process as you go through. And we really encourage it. Everything's powerful, safe, win-loss is great, movement, directions we help you with, and we try and get you to your goals as... So the 2 courses we've been speaking about, Standard is our flagship, and from there you can move on to our more advanced courses, but you have to go through Standard first. This is made up of 7 sessions, and it has a bonus session as well. The homework is included if you're going to do it. We've got multiple entry scenarios. I think last count there was about 7 or 8. I think could be more. Sorry, I really got to count them. And the profit acceleration, like I said, can boost things to 30% to more than 300% over and above the simple ETF primer side of things. It's comprehensive, and the risk management doesn't require huge calculations while you're working along things. It's very simple. It flows. You just concentrate on your trading, and the trade and the risk management, it will sort of take care of itself as it's going. But it's not easy. There is work to do. On the ETF primer, there's only 2 class sessions, and I've trained up both people in both the primer and the standard, and I find that the primer people have more difficulty because they're not immersed in things as long as the standard. So the 2 sessions is enough to give you all the information. It is profitable. You get a couple of entries, a few exits. Like I said, it's profitable, and the risk management itself is quite simple. But it is just a buy and sell system, whereas the ETF standard is buy and increase the amount that you're buying, come into kind of guaranteed profit situation reasonably quickly, depending on the movement, and when you do sort of wind up, you will have made much, much more money than the ETF primer, as Eusebio was showing you on those charts. The standard course starts this coming Thursday, runs for 7 weeks. The normal price is $2,999, and we have a webinar special of $2,399. Oh, that's... Oh, you moved it. Thank you. Yeah, if you have any questions about it, let us know. But you'll be supplied with everything. We use a MetaTrader platform that's the same for everybody from the same broker. We don't recommend brokers, but we use the same broker just so that all the candles are the same when you start comparing charts. We supply all the indicators, videos on how to install them if you've never used MetaTrader before. And if necessary, I can fly in or helicopter in and set your charts up for you. But it's pretty simple these days. Next slide, please, Eusebio. The other course is the primer course, and this is the cut down version. It only runs for 2 sessions, like I said, but there is a bonus 3rd session. This is where Eusebio shows you the whole of the course running together in 3 different scenarios: a winning trade, a losing trade, and a choppy trade in a choppy condition. It's normally $329, and the webinar special is $159. So if you're going to try it out. And if you do the primer, you can always say, yeah, I like this. Let's bump up to the standard. and increase your course to the standard. Once you've done the courses and you repeat them, there are massive discounts afterwards so that there's no barrier to your re-entry. And once you've done enough of those, about 3 or 4 of them, then there's no charge to carry on just taking the courses. We have a lot of people, like I said, people from 2007 still sitting in on the courses. Okay, so slide please, Eusebio. So here are the 2 courses side by side. In the chat area, Craig has already dropped the links to the ETF standard and the ETF primer course if you're interested. We've had a couple of questions come through so far, and to stop me carrying on talking, let me see. Excel sheet. Richard has asked, where is the Excel sheet? And Eusebio we will send the spreadsheet that Eusebio produced out to everybody once the session is finished. What do we use to simulate the trades? Inside MetaTrader, there's an OK simulator called Strategy Tester, which is built in, but we use a third-party one that there's no charge for. It's on the outside. I must say that everything is included in the course, so you don't have to buy anything extra in order to be able to start trading. We do have an extra tool, our trade manager, if you wanted to use it, but that's not a requirement. So the course is complete along those side of things. And as I said, Richard, we use MetaTrader, which is ubiquitous. There's no charge for using that. The feeds are free, and in some cases you can get feeds for all the various indices as well. Okay, and Eusebio, do you have anything else to say? I'm just pulling up some other questions.
Yes, sure. Richard is asking what is the trade manager. The trade manager is an expert advisor with MetaTrader 4. We have developed especially for the Max, and this trade manager, if you watch the video of the open house session we have had 2 days ago on Thursday, I think, or it was Thursday, yeah, and you can ask the video to Craig. You will see what the trade manager, the Max Trade Manager is. It's a tool which helps us to calculate automatically the trade size based on our position sizing concept, which is based on the stop loss size and the risk we allocate to the trade, and then it helps to through buttons to make entries, to make scalings, to make our MX and to make our XXX, so to make easily our entries and our exit with a global stop loss. For all the entries we have just one unique global stop loss, and we can adjust the stop loss manually whenever it is necessary. So it helps to handle the trade in a very easy way, and the tool shows also important information how the trade is evolving in terms of risk and in terms of potential profit, which are 2 information which are essential in our trade risk management. If we don't know how the risk is evolving along the trade, we are pretty much blind in the trade. If we know that at some point we are break-even or we are looking some minimum profit, so we can be much more comfortable in the way to analyze the trade and to handle the trade. And so this is what the Max Trade Manager is doing. It does not execute the trade automatically. You still have to push on the corresponding buttons to execute an order or to adjust a stop loss. So.
Okay, thanks, Eusebio. And yeah, so it's an extra purchase, but you don't have to use it. MetaTrader has got all that built in if you're wanting to do the trading. Not the risk profit side of things, but has got its own order panel that you can use. But people that have used the Max Trade Manager have said that they would rather have their left hand chopped off than not use it, or they would give up their wives for it. So I'm not too sure if that's any good. It's around about $300, Richard. And there's sorry. Okay, I didn't want your wife anyway, but thank you. Okay, but yeah, but it's developed more for the Max people. So if you're using a different system, it may not suit you that well. Okay, yeah, it's quite specific to how the Max work actually operates. Some people have asked about the extra costs. There are no other extra costs apart from that trade manager, which is not a requirement. Monthly payments can be done, and what else was there? So if you speak to Craig, he will work out something for you. And in some cases, Craig can work out something like do the primer course, do the standard course, and also an advanced course as well altogether for an even larger discount if you wanted to go that way. Okay, and how much time do I have to spend to learn this? I kind of touched on that before, but it depends on each person really. If you've got a job, it might take you quite a while. If you're concentrating on it full-time, a shorter time. It all depends on every person, how much experience they've already had. We've had people that have been good traders, especially one from Australia, who after 2 weeks started using this and was using it to increase their profits using the scaling methods within 2 weeks. So it didn't take him long to pick up on the information. Other people it's taken months, some even after a few years are still struggling, but it all depends on the concentration and the effort that you actually put into it.
I can give us my own experience, Chris, just to explain. So, in 2008, I have taken the course with Jim because Jim was still teaching at that moment, and I took the course in March 2008. March, April, and then I retook the course a second time in May and June, just to validate some details and actively participating to the homework. And so it took me 4 months to study the Max and to practice the Max, and then in July I went live. And I went live in July 2008, starting with the 30-minute time frame, and until the end of the year, so on a period of 6 months. So I progressively switched down to the 15-minute time frame and then to the 5-minute time frame. So 4 months to study and practice, and then 6 months to target the time frame I wanted to trade. In a period when the volatility and the momentum were tremendous after the subprime crisis.
Okay, thanks Eusebio. Richard's asked more, do we have a divergence indicators? We don't use them, Richard. We have, once you get into standard, we have 5 or 6 different types of divergence. So trying to bring all those in, and we don't use hidden divergence. That really messes our brains up.
Yeah, and by the way, I have never seen an indicator up to now, despite a lot of attempts. I have never seen an indicator giving always correctly the divergence, the basic divergence, but we have more complex divergences. So this is why there is no indicator for such kind of divergence.
Okay. I'll answer your question soon, Joe. Do we have indicators for Ninja? Sorry, I should have mentioned that. We have some of them for Ninja 7 and 8. I don't know if it's increased since then. And multi-charts and TradeStation as well. But they could be old by now, so I'm not promising that they're going to work straight off. But what we can do is, our indicators are reasonably basic. There's not too much special that goes into them. So if you want to port them to, if you've got a platform that you want to use our indicators on, we're very happy to give you the source code from MetaTrader for ours, or if you need the calculations, those if necessary. But generally a good coder will be able to pull them out of the MetaTrader source. So you can port them across. Several people have ported them over to some of the other platforms, but 5 years ago people were sort of saying, hey, I've just done this, here's the NinjaTrader indicators, please give them out to everybody else. But haven't seen that sort of happen lately so much. The world has changed a bit. And Joe has asked, are there any discounts for Jim Pruitt students? Yes, Joe. So just contact Craig, let him know. And yeah, if you're doing a repeat, there will be a catch-up because things have changed hugely since Jim. In fact, I don't even remember your name, Joe. I'm sorry.
Yeah, I remember Joe Celestine. This is a name I remember.
Okay, cool. Yeah, it's funny. Some of them stick in your head. Sorry, Joe. But Eusebio got you. Hector wants to know what your best month has been, Eusebio. Perhaps
yeah. My best month, I would not consider it as a typical month, but my best month has been in January. Was it 2015 or 2016 when there has been the Brexit vote? And with the Brexit vote, I remember that day I was teaching one session of the Max Advanced course, and I explained to the student that I were a little bit in a hurry to finish the course because I wanted to trade the Brexit as long as the partial result were coming out. And I explained that day, for those who have participated to this Max Advanced course, they can testify. I have told them that I was betting to short the pound, and I have traded the pound yen, because my opinion was based on a lot of analysis that the Brexit vote would have been, so the vote would have been in favor of the Brexit. And then I have traded during the night, during 3 to 5 hours. I have made 3 trades, and I have made a 337 R for the reward to risk ratio with a 0.5% risk. So I have made a 168% profit that day only. And so this has produced my best months since I'm trading from 2008. Now I cannot tell you what is my best month because I no longer need to increase my account. And so whenever my account increases by around 50%, I withdraw all my profits. So my trading account stay constant after my withdrawal. So I cannot tell what is my best month, but it's not untypical that I double an account in 1 month. That's very, very frequent.
Okay. Thanks, Eusebio. Yeah, I was going to say, don't tell us the pips, otherwise it sounds just so obscene.
27,000 pips. With just 3 trades.
Like I said, it's an exception. It's not the norm.
Yeah, this has happened one time only.
Okay, yeah, Robert, it is definitely a wow. Yeah, but and that was using the scaling. So 3 trades, but lots and lots and lots of scalings as well along the way, and quite
not so much. Not so much. In the 3rd trade, there has been 13 or 14 scalings. So not so much based on the movement the price has made. But of course, there was a big challenge with that day to trade the Brexit movement. First of all, if you remember, and this has happened several times later, whenever there is a big event, the brokers have a tendency to decrease the leverage and so to increase the margin. And at that moment, my margin has been multiplied by 4. And when we have a higher margin, we have less possibility to scale it. And I was also expecting a very high volatility. And so to overcome these 2 difficulties, I have taken the decision, first of all, to decrease my risk per trade, 0.5% instead of 1 or 2%, and then to limit the number of scalings I was making, and then to increase my stop loss size, my emergency stop loss size. And that way I have been able to trade rather comfortably and to exploit at best the 3 trades I have made during the Brexit night.
Okay, thanks, Xavier. Okay, so let's wrap this up. Thank you very much for your time. And okay, thank you, everybody.